Well, John and I are back here from the New York Stock Exchange, but I want to toss it over now to Dean Maki. He's the chief U.S. economist at Barclays, also a Bloomberg best, overall on the economy to get his take. And Dean, these numbers were, again, higher than even your estimate, though. However, does this change your outlook at all?
The numbers were a bit better than expected, especially when you combine them with the upward revisions to the previous months. What this suggests to me is that some of the fears that have been gripping markets of late, that the U.S. was headed toward contraction in the third quarter or that we were going to start losing jobs, those were not valid. We actually are gaining a bit of steam as we move into the third quarter.
Okay, and the risk of recession?
We don't think it's particularly high right now. We do think some temporary factors have been weighing on the economy. The drop in gasoline prices that we've been seeing will help consumers, and we think that's an important factor that will benefit the economy in the second half.
Hey, Dean, it's John Erlichman. I want to stay on that point for a second because Jan Hatzius of Goldman Sachs told us this morning that history tells him that when the unemployment rate stays in a very, very tight range, like 1/3 of a percentage point over a 3-month stretch, 6 months later, you do fall into a recession. So you're saying your numbers don't suggest that's the case?
Yeah, that's not our view that will happen. I think the problem is you've got a very limited number of times in the past that you've had examples like that. So I think one wants to be careful about drawing too much from those historical episodes.
But regardless, though, Dean, we know that the data over the last several months has turned quite dramatically lower, right? Or pointing to slower growth here in the economy. Why do you think that is? What is going on here?
I think one of the factors that is holding growth back on a trend basis is that after a financial crisis, the research typically shows that you simply lose a lot of output, and you're not going to grow as fast afterward as you did before the crisis. And I think that's what we're seeing, especially in the revised data we got on GDP last week.
So are you saying then that we saw an overreaction to that revised GDP number last week?
Well, I would say those numbers that were revised were less robust. So there's no way around that. So I think it was appropriate to react to that. But to go from there to say that we're now entering a recession, I think is a stretch.
Then, Dean, I mean, for those who are in the markets right now, what is next? What do we do from here?
I think the important point here is that if consumers do respond to this better real income growth over the next few months, the economic numbers are going to gradually start looking a bit better. And I think markets ultimately will respond to that.
And that means that QE3, any movement out of the Fed, any triggers out of Washington, if any, would be unnecessary.
That's right. We do not think that QE3 is coming, at least in the near term. We think the Fed will hold off and watch the data. They're expecting a gradual improvement as well. If that occurs, they'd like to sit this out, and that's what we expect to happen.
You know, it's interesting, Betty. We just had Nouriel Roubini on, and he said after a few days here, maybe the markets won't feel that great heading into next week. And you start to wonder then, what is going to be that next catalyst outside the U.S.? I mean, Dean, obviously you've still got big questions about Europe. What's first on your mind right now?
Well, clearly the questions in Europe are legitimate, and there is a lot of uncertainty there. In terms of the U.S., though, I think that the job market and the consumer are the keys. If both of those continue on the path that we're expecting them to, we saw auto sales pick up in July, we saw jobless claims fall, we saw payroll growth improve a bit. If those continue, then I think some of the fears that have pushed markets down will prove unfounded.
Okay, and Dean, I know what you're saying about, consumer sentiment and income, but, particularly, what do you think is going to actually start creating more jobs? What has to happen?
Jobs are a function of growth, and we think that the slowdown in job growth in the second quarter was a lagged function of the slowdown in the economy that we saw in the first half. So if the growth numbers pick up, and again there the consumer really is key, then the jobs will follow.
Okay, all right. It kind of feels almost like a chicken and egg scenario in many ways. But Dean, I appreciate your comments on this.